Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of Geodata Vision.
Welcome to today's broadcast of the 911 Show. I'm Len Suzio, and joining me today is Dean Stockford to discuss some of the key banking and compliance developments from June of 2026.
Hi, Len. There are some pretty significant developments within the last few months that are affecting compliance, lending, deposit operations, fraud prevention, and fair lending. So I thought it would be a good time to review what bankers should be paying attention.
Well, I think that's a great idea.
Good. Well, I'll start with one of the bigger developments, and I have a little bit more than that to unpack. But in May, the OCC finalized rules related to escrow accounts. The two final rules kind of reinforced the authority of national banks and federal savings associations to manage real estate escrow accounts. And most notably, the rules affirm that these institutions can decide whether to pay interest on escrow accounts and whether to charge related fees relative to those accounts. And the second rule formally determines that federal law preempts state laws that attempt to restrict that flexibility. So in practical terms, this means banks operating under federal charters have greater consistency across state lines when managing those escrow accounts.
Okay, so Dean, you mentioned that these rules became final in May. What's the effective date for these rules?
Oh, that's a great question, Len. And both of them became effective June 18th of 2026. And the OCC believes reducing uncertainty may encourage additional real estate lending activities.
That's good information for our bank listeners.
Yeah, I agree. And in addition to the OCC escrow rules, of course, another one of the prudential regulators, the FDIC, weighed in recently and updated guidance on official signs and advertising provisions, which govern what the usage, obviously, of the official logo, the signage, and what they must do for advertising.
Sounds perfunctory, but why is it important, Dean?
Well, the short answer is that this is a compliance issue that essentially affects virtually every FDIC insured institution.
All right. So we've got a lot of FDIC listeners, I'm certain.
Yeah.
So can you summarize the updated guidance for them?
Oh, yeah, sure, Len. Yeah, the FDIC updated a Q&A that supports Part 328 of the advertising rules. Financial Institution Letter 22-2026, say that three times fast. Updated Q&As that provide answers to a collection of questions from stakeholders, including insured depository institutions, trade associations, tech companies, vendors, and other entities, and are intended to promote transparency and support implementation efforts. So each Q&A pair includes the date that it was last revised with all of the new, of course, responses to that.
Okay, so when was the last revision?
Well, the latest changes were dated May 13th of 26.
All right. Do you have any recommendations for our financial institution listeners on the updates?
Yeah, I mean, my recommendation would be for compliance, obviously, along with marketing. And these folks don't always talk well together, so it's certainly something that they should do. But compliance marketing, review these updates together to ensure that websites, mobile applications, advertising materials remain compliant, and they should also review their advertisements for compliance prior to publishing, because once you've published it, you're already, the cat's out of the bag, as they say, and you could be facing not just advertising violations, but also violations under what we call UDAP, unfit, deceptive, and abusive acts and practices. So,
okay, that's great advice. Now, I understand another headline involves the CFPB and Reg B. That ought to get a lot of attention. What exactly happened there?
Yeah, well, obviously you and I have worked a lot around Reg B and, of course, fair lending overall. But as you're aware, President Trump issued the Executive Order 14281 entitled Restoring Equality of Opportunity and Meritocracy. which seek to eliminate the use of the disparate impact liability in all contexts. But this has created all kinds of confusion and concern in compliance circles, and it's not over yet. In May, the CFPB finalized changes to Reg B under Equal Credit Opportunity Act. Those changes narrowed certain fair lending interpretations, including the use of that disparate impact theory. Shortly after that, a coalition of consumer advocacy groups, and as we know, they can be very loud, and fair lending vendors filed a lawsuit challenging those changes. And this situation has created some, additional uncertainty because of the litigation around it that could affect how these revisions are ultimately implemented.
Hmm. So, in light of this uncertainty and all the potential confusion and the changes going on, what recommendations do you have for financial institutions in light of these developments?
Yeah, well, personally, I would recommend that institutions, as they always say, stay the course, but continue maintaining strong fair lending programs and monitoring the developments closely. Regardless of the legal outcome, regulators will continue expecting banks to identify and address unfair lending risk. And as you know, Len, you've mentioned this many times before, and that is, administrations change every 4 years. So,
Hmm.
uh,
Oh, yeah.
we could be facing a different administration, and they could be a look back, and they could implement, or pivot and swing the pendulum in the opposite direction or backwards. So, very important that they uh, constantly monitor those programs.
Well, I agree. And as we know, regulatory enforcement for redlining continues to be an issue for institutions. And of course, that's a form and relies on the concept of disparate impact.
Yeah, absolutely. So it plays right into that theory as we've been discussing. So let's pivot though to financial crimes compliance. I hit on a couple of really important topics, obviously already based on the guidance that was issued in that letter. But this is another area that's deemed much higher risk for institutions. And FinCEN, the Financial Crimes Enforcement, issued a joint advisory in June 8th, that is, in Financial Institution 2026-A002 that has received quite a bit of attention.
Well, you described it as a quote joint advisory. It sounds to me like other institutions or agencies, I should say, weighed in on this advisory. Am I right?
Yes, that is correct. And FinCEN, along with the FDIC, OCC, and NCUA, released joint advisory warning financial institutions about fraud schemes that are associated with unlawful employment of unauthorized workers. The advisory highlights risks such as identity theft, payroll fraud, other schemes that they're using to conceal employment activities. It also provides 18 specific red flags that an institution can use to identify this suspicious activity. So I think, folks should certainly study what those red flags are so that they're aware of the types of things they should be looking for. One important point is that regulators encourage institutions to consider the use of individual taxpayer identification numbers within their risk-based customer due diligence framework. And as we know, customer due diligence is that provision that essentially establishes a baseline of risk so we know whether our customers have deviated from it. They're not prohibiting accounts or services, but they're encouraging banks to evaluate whether certain activities present elevated risk. So again, establishing the baseline, did they deviate from that? And ultimately, a red flag goes up, and we'll have to follow up with it.
And I would think that BSA officers and fraud teams would definitely benefit from reviewing these red flags.
Oh, yes, they absolutely would benefit, and they must adjust procedures to address them, or otherwise, they may have some very unhappy regulators.
We don't want any unhappy regulators visiting our bank.
No.
Now, related to this issue, I understand that the CFPB issued a statement concerning immigration status and ability to repay analysis. What's the significance? What's going on there?
Yeah, well, no, that's another great question. I mean, the CFPB stated that a borrower's immigration status may be relevant when assessing repayment ability for mortgages and credit cards. Importantly, the Bureau emphasized that this statement is guidance. It doesn't does not carry the force of the law, but nonetheless, it does signal how the CFPB currently views underwriting risk considerations overall. So critical. Yeah, very critical.
Wow, it seems to put banks between a rock and a hard place. So, with it not carrying the force of law, what should financial institutions do?
Well, I think probably one of the very first steps is the written program. Lenders should review their underwriting policies with certainly, I would think, through a legal lens or legal counsel and ensure any considerations remain consistent with applicable fair lending requirements under Reg B and, of course, other consumer protection laws. It's all about the consumer.
Yes. Any additional fraud schemes within the guidance?
Yes, there it absolutely was, and we'll talk about fraud prevention for a minute because FinCEN also updated guidance regarding Section 314B information sharing, and we have really there's two components in BSA, so it's you got 314A requirements, and then what they call 314B requirements, and 314B is an information sharing platform, which essentially allows registered participants, so a registered financial institution, to share certain information regarding fraud investigations via BSA or the fraud department with other financial institutions, as long as both of them, and we've confirmed it, are registered participants. And so FinCEN clarified that financial institutions can share information regarding suspected fraud under 314B, not just traditional money laundering concerns. So it extends it. The guidance specifically references information such as fraud indicators, cyber related data, IP addresses, video surveillance, and other suspicious transactions. So to repeat, we can share those types of investigations with other financial institutions as long as we are a registered participant and as long as we've confirmed that the financial institution we're sharing the information with is also a registered.
Well, this is an important, potentially confusing topic. Can you elaborate a little bit more about 314B and what it is?
Yeah, well, it's under the U.S. Patriot Act, and it provides a voluntary framework for financial institutions to share information with each other to identify and report activities that may involve money laundering, terrorist financing, or fraud, while offering a safe harbor from liability for participating institutions. And again, this guidance just adds to uh, some of the information that they can share and is encouraging institutions to share that information. So, as a reminder, we should make sure that we're registered and the institution we're sharing with is registered.
Well, that to me sounds like it's one of the most practical updates of the month.
Yeah, I agree, and you'd be surprised how many financial institutions don't actually take advantage of 314B provisions, and I think it's important for their benefit as well as the financial institution they're sharing it with. But registration straightforward, and I cannot understand why some don't participate. So they probably should look at it and consider changing if in fact they're not.
Boy, that's so practical. I almost would ask you to repeat it, Dean. uh, but I hope our listeners, since this is a recording, you can replay this last minute of Dean's advice, which is extremely practical. And I want to thank you for these updates today, Dean. But do you have anything additional to add?
Yeah, just a couple. I mean, I always do. It seems like, but first, I'm just gonna again kind of pivot a little bit. But the FHA removed the requirement that lenders perform appraisal field reviews on at least 10% of quality control reviews for those types of FHA loans, and that's pretty significant. Field reviews they're now optional, allowing lenders to tailor appraisal quality control activities based on risk. So this change provides more operational flexibility while maintaining, core appraisal compliance standards. For lenders with robust quality control programs, it could help reduce cost and improve overall efficiency, given that significant change. Lastly, Congress also appears to be making progress on additional housing legislation. The bipartisan 21st Century Road to Housing Act includes several provisions that could provide some meaningful relief. And among them are proposed changes to the brokered deposit treatment and increasing the asset threshold for qualifying for an 18-month examination cycle from $3 billion to $6 billion, and streamlining the de novo bank information process. So there's also, in addition to that, a proposal for a mentor protege program pairing larger institutions with smaller depository institutions in a pilot program providing flexibility for newly chartered banks meeting certain capital requirements on a safety and soundness standpoint. And while this bill's still moving through the legislative process, and as we know, that could take forever, but bankers should certainly watch it closely because several provisions could have a direct impact on community institutions and specifically the lending area overall.
Well, Dean, this has been an extremely informative podcast, and I think you've offered some really practical advice to our listeners. I certainly appreciate you addressing all these regulatory insights for our listeners today. This is Len Suzio from Data Vision.
And this is Dean Stockford from M&M Consulting saying thank you for listening to today's podcast. And please let us know of any topics you'd like to hear in future episodes.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and Data Vision on LinkedIn for all the latest news and information on compliance hot topics.